Okay, so as we move on here to number 6, let's look at number 6 here, Aaron.
Does the client regularly self-construct its own assets? If yes, does the client have an effective procedure to appropriately identify and classify all construction costs?
So that's a good one. If they're not going out and purchasing the asset, but they're building it themselves, how are they accounting for the all the necessary costs to capitalize? So the procedure is the review of self-constructed assets, and we want to ensure proper accounting for self-constructed assets, right? And ultimately, if the internal controls are weak, what are we going to do then? Any self-constructed asset, we would perform a detailed review. So we make sure that they are including everything that needs to be added to that asset. Because when you self-construct assets, you're having to deal with even the utilities while an asset is being constructed. So say you're constructing your own building. All of the property taxes, the costs associated with utilities while that asset's being constructed is put into the cost of that asset. Then once it's placed into service, those items are expensed. So everything has to be included in that. So for example, I have a client that purchases a piece of property to convert into rental property. Well, they spend 4 months improving the rental property, tearing down walls, replacing adding, replacing carpeting. All of the utilities and all the costs while it's under construction like that can't be expensed. It has to be added to the cost of the property. Okay? That's all part of the improvement. And then once it's ready to be placed into service to have renters, then those utilities start becoming expensed. Okay, then number 7. Thanks, Aaron. Number 7, ARB.
Does the client systematically review major classes of assets for potential impairment?
Why are we worried about potential impairment? We're worried because they might be worthless assets that we're still showing on our books, okay? So we want to make sure there is appropriate accounting for asset impairment. Company performing the review on a consistent basis is a strong control because it eliminates many of the big bath, they call them, write-offs. So basically, consistently looking at these every year is going to keep the numbers fairly current from all of a sudden having 1 year where there's 20 assets that are impaired. What happens if this control is not working? Make inquiries of impaired assets, take a walkthrough of the plant. Okay, same things here. Okay, next.
Does management periodically review asset disposal or the scrapping of assets as a basis for reviewing the assignment of estimated life or depreciation purposes?
So what would be the procedure here? Reviews disposals for potential impact on changing asset lives. Okay, and what is it we're trying to do?
Insure up to the
Yep, ensure accounting is current. And what happens if it's not? Then they're going to provide more of a detailed look at asset disposals to ensure depreciation is adequate. Again, think about it. The nature would be for depreciation to say it's lasting, the asset has an economic life greater than what it is. So when assets are being disposed of and they're showing big losses as at disposal, then that shows that they aren't accurately showing enough depreciation each year to bring that basis down closer to salvage value. Okay? Any questions on this, guys? How are you doing? Let's look at 1335. Are we all together? Risks in property, WorldCom. WorldCom engaged in a fraud that involved fixed assets. Assume we know the following about the fixed asset account called telecommunications equipment. We have a beginning balance, additions, disposals, then an ending balance. We also know that the company swapped some of its line capacity with other carriers such as Global Crossing and Sprint. The effect of those swaps is included. The swaps include an exchange, but only in physical assets, of the right to use Sprint's lines for a percentage of their capacity, lines in the Midwest. In return, WorldCom allowed Sprint to use a portion of its line capacity in the eastern part of the United States. Identify the specific assertions for the audit of the telecommunications equipment and line capacity account for WorldCom. Identify the substantive audit evidence you would gather and evaluate in addressing each assertion using the following format. So basically we want to use the telecommunications copy. Let's see here.
I should pick a easier
Detail assertions, telecommunications and line capacity WorldCom. And the assertion and the audit evidence. Detailed assertion and audit evidence. And then in this one we'll do also the assertion. So for example, when we look at this scenario, we've got the equipment. We have the beginning balances, additions, and disposals. We're going to take the assertions. We're going to start with existence. Then we're going to go to rights and obligations, valuation and allocation, and then presentation and disclosure. So we're going to take each one of these and then look at what we really are trying to do within each of those assertions. And then from there, what are we going to gather? So the assertion here, existence. Then we're going to do rights and obligations. Then we're going to do valuation and allocation, and then presentation and disclosure. So, existence. What are we going to really do?
Make sure all the assets exist.
Really, exactly. We're going to make sure, do they all really, are they physically there? All assets exist. So how are we going to do that?
Review all purchase documents.
We're going to look at the purchase documents. How does that help us know they exist?
Well, if you paid for them, you're gonna have some.
If you
record of it.
paid for them, purchase doc review, then what are we going to do?
Verified against the bank accounts to see that the money actually went somewhere.
I know, but how do you do that with a swap? It says they swap lines, so how, I guess. I don't
Well, they
understand.
still would have some type of purchase document, shouldn't they?
Some type of agreement.
They should have some type of paperwork. So we're going to first begin by reviewing the purchase documents. Now, depending on the scenario and the amount of the dollar value, the book is suggesting that we take a statistical sample, of additions to the fixed assets, and look at the underlying documentation. And we also can physically take a manual physical inventory check. We observe new additions to the fixed assets. So basically look at the documents, then from that, depending on how that is broken down, probably the big dollar numbers, we would absolutely pull them out of the sample and look at them anyway. But take a sample of the assets and really follow through that those assets have the documents, and then we go and make sure we see the assets in place. However that is. You can't look at underground cables real well, but you want to ensure that they're there. Now, rights and obligations. What is it we're really trying to figure out here? Who has the rights? Who has the rights to use the assets that have been added during the year, added for the intended use? Again, what are we going to do here? Look at the documents, Purchase documents. And if we've got any leases, which I really don't want to get into, we would want to review leases to see what kind of leases they are. And then we would also review those swap contracts, review for line use to determine if there are any restrictions. Okay? Make sense, guys? Is it kind of making sense? Valuation and allocation. How are we going to, what is it we want to know here? Are we recording them with the right value? Are they being recorded at cost? And is depreciation computed appropriately? Okay? How are we going to do that, guys? What are we going to do there? Double check accuracy. Okay? And then we might look at some of the assets to determine depreciation reasonableness. And a good one is comparison with the industry, right? On depreciation, depreciable lives. Okay? And then presentation and disclosure. we're not going to really get into that, but basically what needs to be disclosed is in fact disclosed on the financial statements. Okay? How are you guys doing? We'll take one more and call it a day. Let's look at 1345. This is a really good one to just summarize everything in a nutshell. And you'll probably see this one again for those of you who are listening online or in class here. So, in the professional judgment of context case, here, let me pull this up. At the beginning of the chapter, so let's go back and look at that. Beginning of the chapter, you think it's about 720? Okay, so let's look here. The professional judgment and context. In 2010, the Committee of Sponsoring Organizations published a study that provided a comprehensive analysis of occurrences of fraudulent financial reporting that were investigated by the SEC between 1988 and 2007. The results continue to reveal a large number of financial frauds over all sizes of firms and industries. Providing detail on specific types of fraud, COSO reports the two most common techniques used to fraudulently misstate the financial statements involve improper revenue recognition and asset overstatement. The majority of frauds, 61%, involved revenue recognition, while 51% involved overstated assets. The understatement of expenses and liabilities was much less frequent. Misappropriation of assets occurred in 14% of the fraud cases, which was similar to the 12% in COSO's 1999 study. There are many ways in which fixed assets can be overstated, including fictitious assets on books, improper and incomplete depreciation, failure to record impairment of assets, or especially goodwill, expired or worthless assets left on a company's books, or assets overvalued upon acquisition. Of course, not all misstatements are due to fraud. Misstatements can also result from insufficient accounting systems and weak controls, improper accounting judgments, and misclassification of expenses as assets. What might motivate management to overstate fixed assets? What methods might management use to overstate fixed assets? As illustrated by the examples in this feature, overstatement of fixed assets happens frequently. Assume that auditors detect most of the overstatements. What company or economic information or audit tests would likely alert the auditor to the possibility of such misstatements and facilitate auditor detection? What controls can mitigate the risks associated with misstatement of long-lived asset accounts, and how can the results of audits be used by clients to improve their controls over long-lived assets? So that's what we're going to take a look at here. So as we go down here, in the professional judgment, we reviewed the pertinent findings required in a group. What might motivate management to overstate fixed assets? Why would management overstate fixed assets?
Their balance sheet looks better.
Makes their balance sheet look better. Makes their earnings look better. When earnings look better, what happens to stock? It goes up. right?
People wanna buy.
People want to buy. Especially if they've got some compensation related to stock, it's going to help them also. How would they do these things? How does management go about trying to overstate the assets?
Don't depreciate them properly.
Don't depreciate them properly. Capitalize things that really should be expensed. Don't get rid of asset impairments when they need to. Capital leases might be treated as operating leases, okay? Okay, so if we look at C, as illustrated by these examples, overstatement of fixed assets happens frequently. Assume the auditor detects most of the overstatements. What company or economic information or audit tests would likely alert the auditor to the possibility of such misstatements and therefore facilitate auditor detection? What can they do? What do you think they could do here? Various ratio analysis and analytical reviews, can't that help them? Compare year to year?
Yeah.
What controls could help stop any risks or limit risks associated with misstatements of long-lived assets? The what? The audit committee and the internal audit function. You know, those in the internal audit, to make sure that they're actually providing policies and procedures in place. That would help too.
And then the depreciation schedule.
Look at the depreciation schedules. And again, the more standardized procedures are in place and adhered to, the better they're going to be able to trust the controls. Okay. Okay, guys, any other questions? I think we're going to end this and we will start on Monday with chapter 15. We are skipping chapter 14. We're going to move on to chapter 15. Okay? Any questions?